Hello, everybody. Welcome to Wednesday. The S&P 500 was down 0.6% today because consumers are spending too much money. It's kind of an interesting dynamic, but that's kind of where it's at right now. The market is expecting all of these rate cuts starting in March. And when consumer sales came out this morning, they were very good for December, best we've seen in 3 months. Consumer continues to do well. And now the market's starting to readjust. And what used to be about an 80% chance of a market decrease, of a rate decrease in March is now down to kind of a coin flip. And just because the data is coming out showing that things are good. And to me, this is really a perfect scenario. The market is coming down as it adjusts to this, resetting. It's also coming down because we had such a huge run up. That's bound to happen. You don't see markets go straight up forever. They usually have these big runs and then, either come down some or sideways or whatever. Consolidation periods are very, very common and I think very healthy. But nonetheless, you've got a consumer that has been, the pent up demand of the pandemic. They got money during the pandemic as a whole. Businesses, have money that they got. Everybody refinanced at these lower rates. The job market's good. There's a lot of open jobs. The unemployment rate is quite decent. And we've got a scenario where even the wage growth is now growing faster than inflation, which gives the consumers some more power. And I think Wall Street is still locked into the old-fashioned concept of, hey, when you raise rates 5% in total, you end up with something falling apart, and then they have to lower rates, which is very normal. But not if you have a consumer that continues to spend and continues to come out. So that's why we're in the soft landing zone, and we could end up with no rate change for the rest of the year. You got to remember, this Federal Reserve has mentioned multiple times what happened during the last big inflation spike, which is where they got things what looked like under control, started to lower rates because jobs started to soften a bit, and then inflation completely got out of control, and the Fed funds rate went all the way up to 19%. We're at 5.25 right now, so that's a huge differential from where we are now. So, that's what's in the background. That's what they're thinking about, and they're not that interested in erring on the side of lowering rates too soon. They've got, decent job growth numbers. We've got retail sales doing well. Why would they want to lower rates in this environment by March? There have to be something that happens, in this particular environment, something that breaks or something different than what we're talking about now. So I think the market is probably going to have to readjust its expectations for, the number of rate cuts. And that's what we're seeing today, and probably still some profit taking and sideways motion, as we bump up against this all-time high. So not a lot to worry about. I think this is all healthy. I love the concept of having a decent economy that doesn't have, inflation that continues to come back down. That would be great. We'll see. My fear really is that the economy is too good and we get inflation coming back up. But so far, that hasn't been the case. So we'll see how that plays out. But, and certainly we kicked the recession, concept down the road a bit here with this retail sales report even further. So I think that's important also. So anyway, that's what's happening today. I look forward to being able to see what's going to happen tomorrow. Thank you very much.